You've probably heard the phrase, don't put all your eggs in one basket. And when it comes to investing, that's essentially what diversification means. But here's what most people get wrong. Diversification isn't just about owning a bunch of different stocks and bonds into your portfolio. It's about building a strategy that balances risk and return so one bad event doesn't derail your entire retirement plan. Done right, diversification can give you more stability, more confidence, and a better chance of making your money last as long as you do. Hi, I'm Josh Bliss, financial advisor and founder of Gateway Capital Management, now proudly under Balboa Wealth Partners. We help retirees and pre-retirees simplify their investments, reduce taxes, and create a plan for confident retirement income. And in the next 3 minutes, I'll break down what diversification really means, why it's critical for your retirement portfolio, and how to avoid the most common mistakes people make. 1. What is diversification? Let's start with the basics. Diversification means spreading your money across different types of investments so you're not overly exposed to the risk of just one company, one industry, or even one part of the world. Think about it like this. Imagine you own stock in just one company, say a large airline. Your financial future rises and falls entirely with how that one airline performs. If they hit turbulence, like during the pandemic in 2020, your portfolio could plummet almost overnight. Now imagine you expand and you own 50 different airline stocks. That feels more diversified, right? But here's the problem. If the airline industry as a whole takes a hit, your portfolio is still heavily exposed to that one sector. Real diversification means going beyond just owning more companies in the same space. It's about owning different industries, technology, healthcare, utilities, energy, different asset classes like stocks, bonds, or real estate, and even investments in different countries. It's the classic idea of not putting all your eggs in one basket. But investing, you're spreading those eggs across baskets of all shapes and sizes. 2. Why does diversification matter? Here's why diversification is so critical, especially for retirees. Imagine two couples, Mike and Lisa, and John and Karen, both retired in 2007 with $1 million in their portfolios. Mike and Lisa put almost all of their money into U.S. financial stocks because banks have performed so well in the years leading up to their retirement. John and Karen, on the other hand, took a more balanced approach. They held a mix of U.S. stocks, international stocks, bonds, and some real estate funds. Then the 2008 financial crisis hit. Mike and Lisa saw their portfolio cut in half because financial stocks were among the hardest hit during the crash. Their $1 million dropped to just $500,000, and they were forced to dramatically cut back on their retirement spending. John and Karen's portfolio also dropped, but by only about 20% instead of 50%. Their bonds and real estate held up much better, softening the blow from the stock market collapse. By diversifying across different asset classes, John and Karen gave themselves more stability and avoided panic selling at the worst possible time. This is the power of diversification. It doesn't eliminate risk entirely, but it helps you manage it. So when markets get rocky, and they will, you're not left making emotional decisions that could derail your retirement. 3. How to diversify the right way. This is where many people make mistakes. True diversification isn't just about owning a lot of investments. It's about owning the right mix for your unique goals and stage of life. Here's an example. David is 45 and still 20 years from retirement. His portfolio leans heavily on stocks for growth, including U.S. and international companies, because he has time to ride out market ups and downs. But Susan is 65 and retiring next year. Her portfolio looks very, very different. She shifted a portion of her assets into high-quality bonds and dividend-paying funds. These gave her more stability and provide a source of income so she doesn't have to sell stocks in a down market. A well-diversified portfolio for a retiree might include stocks for long-term growth, keep up with inflation, bonds for income and stability, real estate funds, or alternatives for added balance and potential cash flow. And here's the key. Diversification isn't a set it and forget it strategy. Your portfolio should evolve as you move from growing wealth to protecting and drawing from it. For retirees, this shift is often called de-risking. It doesn't mean eliminating all growth investments, but does mean building in buffers so your retirement income isn't at the mercy of market swings. 4. Common diversification mistakes to avoid. Let's quickly talk about where people often go wrong. Mistake number 1, thinking you're diversified when you're not. Some investors own dozens of mutual funds or ETFs, but don't realize they all hold the same underlying stocks. This creates the illusion of diversification while still leaving them exposed to one sector. Mistake number 2, over-diversify. Too many overlapping investments can make it hard to manage your portfolio effectively. You want balance, not chaos. Mistake number 3, ignoring global diversification. Investing only in U.S. companies may feel safe, but it limits your exposure to growth opportunities in other parts of the world. This is where a financial advisor can help you see the big picture and avoid these traps. 5. Why diversification is especially important for retirees. In retirement, your portfolio has a new job, not just growing, but showing consistent income and protecting you from market shocks. This is called sequence of returns risk, the risk of experiencing a big market loss early in retirement. If your portfolio isn't properly diversified, a bad year in the market could force you to sell investments at a loss to cover your living expenses. Diversification helps protect against that. By having income sources like bonds or dividend funds, you can avoid selling stocks during a downturn. That buffer can make all the difference in keeping your retirement plan on track. So let's take a step back and think about why this matters. Diversification isn't just about trying to time the market or pick the next winning stock. It's about building a portfolio that's resilient, one that can weather storms, adapt to changing markets, and give you confidence that your retirement savings will last as long as you do. Markets will rise and fall. That's inevitable. But the retirees who get through those ups and downs successfully are usually the ones who took the time to diversify their investments properly, balancing growth with protection and designing a strategy for steady income. Here's the thing. True diversification isn't a one-size-fits-all formula. The right approach depends on your personal goals, how much risk you're comfortable with, and how close you are to drawing income from your portfolio. And that's where working with a financial professional can make all the difference. If you're within 5 to 10 years of retirement and want to make sure your investments are properly balanced, not too aggressive, but not overly conservative either, let's talk. Click the link in the description below to book a free consultation. I'll help you review your current portfolio and show you how to align it with the retirement you're working towards. Retirement doesn't require guesswork, it requires a strategy, one designed to protect what you've built and provide the confidence to enjoy this next chapter. Thanks for watching, and if you found this helpful, don't forget to like this video, subscribe to the channel, and share it with someone else who's planning for retirement.